Why don't we cut you up into little pieces and feed you to your pooches? And then we'll see how loyal a hungry dog really is. It's not about money. It's about sending a message. Everything burns.
Occupy Wall Street all day, all week. Occupy Wall Street.
Wall Street, it crashes, and people starve, people lose their jobs, things like that. We're very angry at Wall Street. It's the heart of capitalism, American capitalism especially. That's why we're here today at Wall Street.
Tonight, there was an emergency Zoom call with several hundred members of Congress. It was convened by the Treasury Department, and we were given about 15 minutes notice. It was literally on regular Zoom. I was sent a link, I clicked the link, and most of Congress was there. That's not normal, but neither is the situation. The purpose of the meeting was to announce extraordinary steps that will now be taken to secure our financial system. You're going to hear from the president today, along with leaders of both parties, but here's what's happening. 3 days ago, we had the second largest bank failure in American history. It happened because there was a bank in California called Silicon Valley Bank. It lost a lot of money, causing a lot of its customers to get scared and try to withdraw their money, and it caused a run on the bank. So the federal government, through the FDIC, stepped in and closed the bank. Here's the problem. Typically, your deposits in a bank are only protected up to $250,000. But the vast majority of customers at this bank had deposits more than that because this bank specialized in startups and small businesses. And the uncertainty about what would happen to customers with more than $250,000 in deposits started to spread to other banks. A New York bank failed last night. Others have started flashing red. And we were in the early stages of a domino effect. Which brings us back to the emergency Zoom call. All the depositors at the Silicon Valley Bank will be made whole. Same with the bank in New York. We're going to pay for that with the fund that banks already pay into, not with taxpayer money. Right now, every step being taken has one purpose: to make sure this domino effect ends now.
The vast majority of my audience is old enough to remember the 2008 economic crash and how it quickly became viscerally clear that America cherished the elites and couldn't care less about the poor and downtrodden.
Those protests against Wall Street continue to grow across the country today. Here in New York, thousands of demonstrators descended on the financial district as big labor unions joined in, and many people down there asking the question, what are the people who helped create the jobs crisis doing to help the people out of work? ABC's Cecilia Vega spent the day in the middle of the protest.
A lot of deregulation of Wall Street and mismanagement led to close to 10 million Americans losing their homes, either through foreclosure or bank-approved short sales. All while CEOs of these banks that collapsed got paid generous bonuses. People have become filled with contempt and rage at the government and these institutions. The people haven't forgotten. And now it looks like it could happen all over again. So, introducing the Great Recession 2.0, or should I say the Great Recession Remastered Edition. I consider myself a bit of an armchair economist. I really enjoy topics such as economics, and I want to do more videos like these with more deep dives on economics. And if you want to see more of them, don't forget to like, subscribe, and hit the bell icon so that you can be updated when I post a video. So let's take a look and see why the Silicon Valley Bank just might have changed the way banking is done in America, and if we are headed for another recession. Before we get started, I want to quickly touch on how banking is kind of a scam. They create this illusion of safety where you can put your money into them and it'll be kept safe, but time has kind of proven these institutions are inherently untrustworthy and constantly need to be bailed out by the taxpayer. Anyway, I digress. When you put money into a bank, if it's a very large bank, they are required to hold on to 10% of it in case people go to withdraw their cash. The bank lends the money out to other people so they can buy things like cars, houses, or the bank will invest it elsewhere. The profit they make off your hard-earned money, they keep almost all of it. And literally, like on a Chase savings account, for example, they give you 0.01% back on the money that you technically lent them. The whole thing is turning into one big scam. During the pandemic, the amount banks had to keep in reserves was literally reduced to zero, which explains why it was so hard to get cash out of an ATM, because banks literally had given it all out. Banks have to create this illusion of stability in the hopes not too many people ask for their money back, because the bank doesn't have it. It's all lent out. This is what is called a bank run. When too many people want to take their money back out of the bank, this is what this is literally what happened to the Silicon Valley Bank. First, I want to touch on some of the negligence and just sheer recklessness of this bank. In case you haven't heard already, the Silicon Valley Bank went bankrupt. It was the 16th largest bank in the United States and the biggest collapse since 2008. Making everyone wonder if this would snowball into another banking crisis. But as everyone expected, magically, the government quickly rushed in to help it as always.
First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today.
People's deposits in the bank were insured for up to $250,000, but somehow the government, like always, decided to be extra generous to the wealthy and make sure everyone who had money in the bank would be made whole again, even if it was over $250,000. At the Silicon Valley Bank, north of 93% of the bank's $161 billion in deposits were uninsured per a recent regulatory filing. So why would wealthy clients put their money where it's uninsured in case of a disaster? Sounds like a really low IQ move to me. It turns out even Roku had $487 million held at this bank, representing about 26% of its cash and cash equivalents as of March 10th, 2023. But think about it. This sounds like some of the worst risk management I've ever seen. But if you sell more than $600 worth of stuff on Cash App, you get slapped with a 1099 tax form from the IRS, and yet these companies just willy-nilly all the time and just get away with it. Keep in mind, the CEO and other executives sold tons of stock and gave out bonuses moments before the collapse, but still got bailed out. Also, in 2018, the Silicon Valley Bank lobbied the government for deregulation that changed the Dodd-Frank Act. For those of you that don't know, the Dodd-Frank Act was a pivotal act that helped regulate banks after the Great Recession. And it put higher requirements on banks with over $50 billion in assets. Things like liquidity and capital requirements, harder and more frequent stress tests. But in 2018, Republicans loosened many requirements, making it so only banks with $250 billion were held to these standards instead of the prior $50 billion. All in the name of helping the little banks. They included in there a little thing that required the little banks basically the ability to hold 0% reserves. That literally means small banks can loan out every dollar they have. So if you want to go withdraw your money, they don't got it. They literally have to get it from somewhere else. Surely there's nothing risky or unstable about this practice. This is just like East Palestine, where deregulation led to what could be Surely there's nothing risky or unstable about this practice. This is just like East Palestine, where deregulation led to what could have prevented the derailment. Some might say, well, at least we didn't have to bail them out like last time with our own money. It was FDIC insured. The bank's paying to that, right? Well, the banker's spin on this is going to be that they will likely have to pay more in FDIC insurance. But who do they think is actually going to pay that? The banks or the customers, whose fees will almost certainly go up? Again, just like in East Palestine, the train derailment, where at the end of the day, it's normal people who suffer at the hands of big banks, Wall Street, and corporations, where it took weeks for the government to step in and test the water and air, but only 2 days for them to completely change the way banking is done. All of that is just the appetizer. The real issue, the real reason this is so important was because after the government had to step in and bail out the Silicon Valley Bank, they made one critical change, and it basically took all the risk away from banks and basically put it into the lap of us, the taxpayers. That crucial change was that no matter how reckless banks will be, the government will ensure everyone's deposit in a bank. Essentially, every bank overnight becomes too big to fail. To the layman, this might be confusing, but what it means is the federal government essentially said to them, don't worry about the risk, we will take care of it. You just worry about making more and more money. But let's admit it, once the government guarantees all deposits, the business of banking isn't much of a business at all, and maybe shouldn't be. And this is why the Silicon Valley Bank changes everything. This is likely to become the biggest debate of the coming weeks and maybe even months. The government also injected $210 billion into the 4 biggest banks in America to help them stay afloat. But surely that won't affect inflation, right? They don't want to call this a bailout, but in effect, that's what it is. And with these new rules in place, there's nothing stopping the bank from using this to their advantage and paying themselves, again, generous bonuses, even if the banks collapse like last time. And we, the citizens, the public, asked for nothing in return. Well, we didn't even get the chance to. If the United States government is going to guarantee all deposits of cash in all banks, then why should banks be allowed to trade on that money and earn outrageous profits if they pay nothing for messing up? The banking system is more or less basically just quasi-nationalized at this point, where costs are constantly paid by the public and the profits are given to the elites. Either banks are private with attendant risk or they are public. Every bank with a balance sheet that's in the red just got the ability to have their whole balance sheet covered. If you're a wealthy billionaire who puts over $250,000 in a bank, that's all covered too. Despite the fact, keep in mind, despite the fact that the bank didn't even pay enough insurance to cover that cost. So who's going to cover that cost? You, the taxpayer. The whole point of FDIC insurance was so that the little guy who just needs a place to keep their money safe can get it back. Technically, only $250,000 back, but you get the point. In the event the bank collapses, but it's meant to discourage wealthy people from putting all their eggs in one basket in case of a bank collapse. That just happened. The FDIC insurance only has roughly about $125 billion in it, and there are also about roughly 9 trillion bank deposits not insured by it. So when the FDIC runs out of money, want to take a guess who they will get that money from? Exactly, you. Think about this as well. If every bank is now a government-sponsored / guaranteed enterprise, then why not simply have government banking? All we've done is insert a facade of middlemen. I'm struggling to see why a private bank needs to exist if there is literally no risk. They basically get to be as reckless with money as possible and always have the government bail them out now. Here's a letter written by the Treasury Secretary outlining their plans to go above and beyond for a bank that had more than 93% of people recklessly put their money in that wasn't insured. All banks are now backstopped by the government, aka us, the regular, everyday public, the taxpayer. Banks essentially have infinite insurance. What makes this worse is that this is coming from banks that give your savings account an interest rate of next to nothing. Chase savings account, as I mentioned earlier, has a savings rate of 0.01%. Rates for the bank's premium relationship savings accounts are slightly higher, but still don't compare to online savings accounts from companies like Ally that have rates closer to 4% or higher. On top of that, due to our fragile fractional reserve banking system, it only requires big banks to have as little as 10% of the customer's funds available in cash, while the rest is lent out with no minimum for small banks. Keep that in mind, with no minimum for small banks, because, stability. What could possibly go wrong? These bank executives get to use our hard-earned money to loan out and make risky investments when they only pay as little as 0.01% in interest while paying themselves fat bonuses. The sad reality is if the banks make a major mistake, this will take the whole system down with how much more entrenched the government and banks have become. It's always funny how the elites get the red carpet rolled out for them, but the poor are constantly told to pull themselves up by the bootstraps. I think the lesson is that the Dodd-Frank regulations should have never been repealed or loosened, and in fact, they didn't go far enough. Now, what's the likelihood of another recession? Currently, the Silicon Valley Bank claimed it needed to be deregulated because it was a mid-sized bank and it didn't pose a threat to the system. Well, that clearly turned out to be false. The Federal Reserve just gave them, among some other big banks, a $210 billion bailout, but they won't call it that, which adds to the already high inflation. Plus, other banks have begun to fail too, like the Signature Bank and First Republic Bank that just got a $30 billion lifeline. This is bringing us back to the same problems we had prior to 2008, with banks being allowed to do more or less whatever they want while nothing is being asked of them. The Federal Reserve has also explicitly said it's raising rates to crush wages and increase unemployment in the hopes it will stem off inflation. But at the same time, it's going to cause a recession. Not to mention the rate at which rates are increasing are unprecedented. The faster rates go up usually indicate anything but a soft landing. Couple that with our aging demographic and stagnant wages, and I would say the odds of a recession are extremely high. The odds of one on par with 2008, I would place at around 60% due to us not having much debt we can leverage as before to help get ourselves out of this mess. Our debt to GDP ratio is already deeply concerning. I would have also loved to go into how banks can sell a loss off their balance sheet and the Fed will redeem it at the original value. It's this is just fraud. But I'll probably save that for another video since it is literally just legal accounting fraud.